Alright, so in this video we're going to quickly go across some of the common hedge fund formulas, some of the common formulas used by hedge funds. So let's get started. The first category is going to be performance and risk. So performance plus risk, that's our first category. And the first one I reckon we go with is Sharpe ratio. So what's Sharpe ratio used for? It's to measure risk-adjusted returns. So the first category is performance and risk, and the first formula is Sharpe ratio. Sticking to the same category, we go with the second formula in the same category would be value at risk, VAR. Now value at risk estimates the maximum potential loss over a specific period of a given confidence level. So estimates max potential loss over a given confidence level. So that's value at risk. The next one is Sortino ratio. Sortino ratio is kind of similar to Sharpe, but it only considers the downside deviation. Alright, let's just write that down. Similar to Sharpe, but only considers downside deviation. Only considers downside deviation. Next one is drawdown. This is pretty basic. It measures peak to trough. Decline during specific period. So that's the category of performance and risk. These are some of the common formulas used in this category by hedge funds. Let's move quickly to the next one. Or we could do another one in this. Skewness and kurtosis. Let's see if we can do it here. So skewness, it kind of describes the asymmetry and tailoredness of relative distribution to identify non-normal risk. So the way we write that describes the asymmetry of return distributions to identify non-normal risk. This is used to basically identify non-normal risk. We'll just leave it at that, trying to make it as simple as possible for you guys. Identify non-normal risk. Alright, go to the next one. What's the next category? Let's do relative performance. Relative performance. The first one is the title of these videos, Alpha. The Hunt for Alpha. Now, what is alpha? It's the excess return of an investment. The excess return of an investment let's just say relative to a benchmark, like S&P 500. Let's add in there given its risk level. Given its the risk level. That is alpha. It's basically the excess return relative to a benchmark. Now, what is a beta? Beta measures a fund's sensitivity. Measures a fund's sensitivity, or you could say volatility, relative again to a benchmark. Again, like the S&P. And one more, we could do one more in this, and that would be correlation. Correlation, it's a statistical measure of how, let's say, two securities move in relation to each other. That's correlation, alpha, beta, and correlation. These are the three main ones. So let's quickly move on and go to the next one. Could just pause this for now and come back. Okay, next one is derivatives pricing. How do we calculate derivatives pricing? First one is very famous, Black-Scholes Merton. This is the foundational model for pricing. Options. Foundational model for pricing options and calculating Greeks. Next one would be Greeks, delta, gamma, and vega. These Greeks basically measure options price sensitivity. Let's see if I want to write all of that. Just say measure an options price sensitivity. Just to put it in simple terms. The next one is local and stochastic volatility. So these are basically advanced models of pricing options. These are the advanced models with skew effects. Let's just add that. Skew effects. That's an important element to measuring stochastic volatility. All right, let's keep going. Next one is quant strategies, and the first one is co-integration and pairs trading. This is used as I always struggle to say that. Statistical method to identify two assets whose pricing moves together. Or you could also say add, how would you say it? You could say betting on spreads reversion. All right. Let's say mean reversion models. And this uses mathematical frameworks to identify and trade the tendency of asset prices. And trade the tendency of asset prices to return to a historical average. Oh, the next one is PCA, Principal Component Analysis. It's a statistical technique to reduce the dimensionality a statistical technique to reduce the dimensionality of data. Alright, let's keep moving. Now guys, let's do one last one, but this is not an exhaustive list, so there's other formulas used, but I'm just gonna keep this video short and not confound you guys too much. Next one, to measure position sizing, we have Kelly criterion. Now Kelly criterion is a formula used to determine the, say, optimal size of a series of trades to maximize returns over time. Okay, so that's Kelly criterion. It's to determine the optimal trade size. And I think we do a mathematical example of that. Let's do an example of the last one, Kelly criterion. So Kelly criterion, let's do an example. Let's first list out a scenario. Let's say you have a quant strategy with the following metrics. You have an expected annual return, which can be written as U of 25%. And let's change that into decimal. Let's say you have an expected annual return of 25% with this quant trading strategy, and your risk-free rate X represented by R is 5%. Your annual volatility why do I struggle to write volatility? Represented by that is 30%. And your variance should be squared. That is 0.09. Okay, let's say you have this matrix for a quant trading strategy, and how would you calculate the full Kelly on this? Okay, so we'll just do it on the other side. So Kelly for the previous strategy would be, let's list the formula out. U minus R over squared. And so we just put the values in for the matrix, which would be 0.25 minus the R was 0.05 over 0.09. Which would give you 2.22, or you can also write that as 222%. So for the strategy that I mentioned before, the optimal Kelly, the Kelly would be 2.22. So what does that mean basically? So what does that actually mean? So let's say you have a capital, trading capital of 100,000 capital. For 100,000 capital, based on this Kelly, you would take a $222,000 position. So with 100,000, you would take a $222,000 position, and how do you do that? You would borrow the 122,000. Okay, that's what it basically means. And you can, for some of the traders, they manage volatility by going half Kelly or quarter Kelly as well, just to manage the volatility. So that is an example of how one of the formulas is used in a hedge fund space. And not to make the video too long, guys, if you found some value in this video, make sure to hit the like button, hit the subscribe button, and I'll see you guys in the next video. Thanks for watching.